How much home can you purchase if you make $100,000 to $150,000 of income using an FHA loan? The reason we're doing FHA is because FHA is the most flexible. It's the most lenient when it comes to underwriting. They allow you to use more of your income towards debt, which essentially means that you can qualify for more home using an FHA loan than any other type of loan program out there. On top of that, FHA only requires a 3.5% down payment in addition to allowing credit scores as low as 580. So in today's video, we're going to do two different things. We're going to show you how to calculate your income for one, and on top of that, we're going to show you how much home you can afford with that income. Now, one thing I want to be very, very clear on early in this video is this video should be used primarily for novelty purposes only. You shouldn't be using these calculations to figure out if you're qualified, how much home you can actually afford. You should be doing that through a mortgage professional. This is more or less for you sitting around trying to get some back of the napkin calculations, if you will, to get a rough estimate of how much your mortgage payment would be and whether or not you can qualify. But if you're truly someone interested in figuring out how much home you can afford, make sure you're speaking with a mortgage professional. If you don't have one, I've put a link in the description below of somebody that I know, like, and trust that can guide you through that process. So the very first thing we're going to do in today's video is calculate income. Now, earlier in the video, I mentioned how much home can you buy if you make $100,000 or $150,000 of income. Now, there's a big difference between those two numbers. One is nearly 50% higher than the other number, but I'm doing it just to give us a range, because if I did just a $100,000 video, you guys would reach out and say, how much for $150,000? So I thought I would do an all-encompassing video to give you an idea of both incomes so you know exactly how much home you can purchase if your income is within that range. Now, with that said, lenders will use your gross monthly income. That's your income before any taxes are taken out. Now, why do lenders use gross monthly income versus net? Because people have different deductions that they take out of their paycheck. Some people contribute to retirement accounts and just different things. So the easiest way to calculate income is using gross monthly income, which is essentially how much money you make before taxes divided by 12, divided by the year. Now, here's the thing. This is really easy to do if you're a wage earner. You get a check every single week or twice a month or once a month, however you get paid. Whereas it's a lot different if you're self-employed and you don't receive paychecks and you're a business owner that has write-offs and all of that stuff. And that's why it is super important to make sure you're speaking with a mortgage professional when going through this process so they can calculate your income correctly, because everything is based off that initial income amount. So if you get the income calculation incorrect from the start, then all of the numbers going forward are going to be off as well. So let's start with calculating the income for a $100,000 wage earner. So if you make $100,000 per year, that essentially breaks down to $8,333 per month. Now, if you didn't have any other debts at all, the calculation is really simple. But if you have debts, it's going to be a little bit more difficult to calculate. So we're going to do some calculations with no debt, and we're going to do some calculations with debt to show you exactly how much home you can purchase. Now, earlier in the video, I mentioned that we're going to use FHA because their underwriting guidelines are the most lenient. They allow you to use more of your income towards debt. Well, FHA will actually allow you to go as high as a 57% debt to income ratio, which means that they'll allow you to have up to 57% of your income go towards debt every single month, which includes your mortgage payment, property taxes, insurance, mortgage insurance, any HOAs on that property, on top of any other debts you might have, like credit cards, car payments, student loans. So everything is calculated into that total debt to income ratio, which is essentially where FHA maxes out at 57% on the back end. So like I mentioned a moment ago, we're going to do it with debt and without debt. So if you had no monthly debt, that $8,333 would allow you to spend $4,750 every single month towards your mortgage payment. So with zero debt, you can spend nearly $4,750 towards your debt to income ratio. Now, again, that is using a 57% debt income. Not everyone is going to qualify with a lender to use 57% of their income towards debt. In fact, if you have lower credit scores, your debt to income ratio might actually be capped at a lower percentage than this 57%. 57 is for those that are actually well qualified, that have good credit out there. So just understand there has to be a little bit of flexibility in these numbers. And again, the reason that I'm going to tell you that it's super important to make sure you're talking to a mortgage professional when going through this process, not using my numbers here, even though they're accurate. Just make sure you're speaking with a professional to make sure you're getting accurate information. Now, on the flip side, we're going to use somebody that also has debt, because a lot of people out there aren't running around with no monthly debt. They do have things that they have to consider every single month, like credit cards, like car payments, like student loans. So in today's video, we're going to assume in scenario number 2 that you have around $450 of monthly debt. We're going to say that you have a $300 car payment. We're going to say that you have around $50 in credit card payments, the minimum monthly payment that's due every single month. And we're also going to assume that you have student loans, let's say an IBR payment of $100. So all in, we're going to assume that you have $450 of monthly debt. So in this case, how do we figure out how much of your income can actually be used towards a mortgage payment? Well, we take that same number of that $100,000, we divide it by 12, that gave us $8,333. We know that 57% of that, which is the max debt to income ratio, is $4,750. So what we have to do is take that $450 out of that $4,750, which essentially leaves us with $4,300 of income that we can use every single month toward our mortgage payment. So the question now is, how much home does $4,300 get you? And that's exactly what we're going to dive into right after you hit that thumbs up if you found any value in this video so far. And do me a favor, also feel free to subscribe to the channel to stay updated on everything FHA and real estate related. Well, how much home can you buy with that payment? Well, before we dive into that, one more thing I want to do. I also want to break down that $150,000 of income as well, so that we can run the numbers simultaneously. You know both calculations, so depending on where you fall within that spectrum, you have an idea of, when we're calculating these house prices, of exactly how much home you can afford. So if you make $150,000 per year, that breaks down to $12,500 per month. Well, 57% of that, right, our max debt to income ratio is $7,125. So if you had no monthly debt every single month, you could spend up to $7,125 towards your mortgage payment. But let's again assume that you also have those monthly debts, the same debts that we mentioned earlier: car payment of $300, credit cards of $50, student loans of roughly $100 a month, so $450 of monthly debt. That would mean that you could spend up to $6,675 of your income towards debt, assuming that you could get the approval at a 57% debt to income ratio. So right now we have 4 different things going on, right? We have no debt at $100,000, we have with some debt at $100,000, we have no debt with $150, and with some debt at $150. So what we're going to do now is look at a couple of different house payments to see exactly how much home you can afford. The first one we're going to look at today is a $600,000 home. So if you were buying a $600,000 home, you were using an FHA loan. FHA requires a 3.5% down payment. So in this case, that is $21,000. So you take $600,000, you subtract the $21,000. That means you have a base loan amount of $579,000. But here's the thing, FHA has something called upfront mortgage insurance. It's required on every single loan, regardless of how much money you put down. The cool thing is, FHA actually allows you to finance this amount, so you don't have to bring additional cash in, just the 3.5% that I mentioned earlier, but it's a 1.75% fee, and it's essentially added back to that base loan amount of $579 that we mentioned earlier. So 1.75% of $579,000 is $10,132.50. So we add that back to $579, which gives us a new base loan amount of $589,132.50. At today's interest rates of 5.75%, your mortgage payment is going to be $3,438 per month. On top of that, you're going to have property taxes. The nationwide average is 1.1%. That's essentially what it is here in California as well. But if you're in states like Florida, Texas, your property taxes are going to be significantly higher. That's why you need to make sure you're working with a professional in those markets that understand the tax rate so they can use the correct numbers. But at 1.1%, your property taxes are going to be $550 per month. In addition, you're going to have monthly mortgage insurance. So FHA also requires monthly mortgage insurance on top of the upfront mortgage insurance. Now, the monthly mortgage insurance stays on the loan for the life of the loan. When you put 3.5% down, it never falls off. Now, you can get rid of it by selling the property, by refinancing refinancing into a conventional loan, but as long as you have FHA, that monthly mortgage insurance is going to be on the loan. Now, there is a case that if you put 10% down on FHA, it will fall off automatically after year 11, but for the purposes of this video, it's going to be on there for the life of the loan. Now, one cool thing is that FHA just changed the monthly mortgage insurance premium amounts, so it's now 0.55%. So in the case of this $600,000 purchase, your mortgage insurance is going to be $270 per month. On top of that, you're going to have homeowners insurance. For the purposes of this video, we're using 0.35%, which in my opinion is going to be high. But again, some areas like Florida, they get a lot of different weather patterns and a lot of different types of weather, different events, hurricanes, all the craziness. Insurance is going to be high. Whereas if you live in Southern California, your insurance is relatively low. But in this case, it's $175, which means that your total mortgage payment in this case is $4,433 per month. So in the case that you make $100,000 and you have no monthly debt, you could actually buy this property using the numbers that we provided today. But if you have the debt that we spoke about earlier, that $450 of debt, you are maxed out at $4,300. In this case, the mortgage payment is $4,433, which is higher than what FHA would allow based on the example that we used earlier, which means that you wouldn't be able to go up quite as high as $600 and would have to find something probably closer to $575,000. And instead of going through all of the calculations with all of these different loan amounts, at $500,000 using the same calculations that we did just a moment ago, your payment would be $3,694 all in, which means you shouldn't have any problems qualifying with $100,000 of income using the examples that we gave earlier, whereas $650,000 would give you a total payment of just over $4,800, which means even if you had no monthly debt, you'd have a very hard time qualifying for a $650,000 home with just $100,000 of income. Now, what about if you make $150,000 of income? How much home could you purchase in that case? Well, again, with no monthly debt, our max mortgage payment was $7,125. With the $450 of monthly debt, remember the max we could use is $6,675. So let's run through two different price points here just to see exactly how much we can afford. The first one we're going to start with is $800,000. If you were to buy it using an FHA loan, that requires a minimal down payment again of 3.5%. In this case, that's $28,000, which means you're financing $772,000. The upfront mortgage insurance in this case is $13,510. So once we add that back, our new base loan amount is $785,510. At an interest rate of 5.75%, that means our mortgage payment would be $4,584 a month. We have to add the property taxes back on top of it, which would equate to $733.33. In addition, we're going to have that monthly mortgage insurance. Now understand with FHA, when you have a base loan amount higher than $726,200, the monthly mortgage insurance is no longer 0.55%, it is 0.75%. So in this case, the monthly mortgage insurance is going to be $490 per month. And using the same calculation that we did earlier for homeowners insurance at 0.35%, which again, I believe to be high, that's $233 a month. So all in, your total mortgage payment would be $6,041 per month. So in the case that you make $150,000 of income, you could qualify for this home, even if you had that $450 of monthly debt that we mentioned. But could you go as high as a $900,000 home? Well, instead of running through all of those calculations again, just realize a $900,000 home, the total mortgage payment on that using the same numbers that we used before is going to be $6,796, which means if you had no monthly debt, you could likely qualify for that home because it would be under the 57% debt to income ratio. But in the case that you have that $450 of monthly debt, you'd have a very hard time qualifying. You'd probably be closer to $850,000, maybe even as high as $875,000. But like I've tried to stress many times in this video, don't go off of these numbers. Make sure you're speaking with a mortgage professional, going through the process, having them actually look at your tax returns, looking at your income to see exactly how much income you make, and also running your credit, because from there they can look at your monthly debts and they can give you a really good picture of exactly how much home you can afford. But if you're new to the process, just starting to understand how all of this works, you know you want to be a homeowner, but you're not sure about everything else? Well, I created a first-time home buyer course to guide you through the process from A to Z. So if you want to become an expert on the home buying process, do me a favor and check the link below. So hopefully today's video provided some clarity for you with regards to how they calculate income, how they calculate your monthly payment. But maybe you don't make quite $100,000 or $150,000. Maybe you make under that amount and want to see how much home you can afford. Well, I went over in this video here.